Great. Thank you so much for coming, and thank you so much to our speakers for virtually joining us as well. I'm hoping technology is our friend today, and this all works out, and we get a good connection. There's been a lot of talk at COP about the technologies needed to reach net zero. And one of the big levers for scaling those technologies is the finance behind it. The last few years, we've seen actually relatively small amounts of VC, PE money and very little public money going into climate tech startups. This year, in the last 18 months particularly, has actually been very different. We've seen this year, just between January and September to date, over $40 billion of money going into the VC, or from VC PEs to startups, in what we would call climate tech. And there's been dozens of IPOs and particularly SPACs as well, helping get access to climate technologies, or helping give access to public market funding. I am really excited today to be joined by three gentlemen who know this space incredibly well, and we're going to be talking about recent trends, who's raising money, what needs to happen, who these investors are, and what to expect to see in the next year or two. So I hope it's going to be very, very helpful and interesting. I want to start off by actually talking a bit about climate tech, or clean tech 1.0, because we've seen this before. About 10 years ago, there was a big rise in VC funding into clean tech, solar, wind, storage. And actually, some of it had success, but some of it fizzled away. So maybe, Jigar, Shah, given you've got such a long experience in this space, do you want to start off by telling us a bit about how is this time different to what we saw in clean tech 1.0? How is kind of funding now and excitement about startups different?
Yeah, thanks for that question. I'd say that people get confused about the returns that investors make in venture capital and the returns that the public makes in decarbonization. So when you think about Clean Tech 1.0, you know, the governments around the world set up feed-in tariffs. They set up all sorts of you know, learning curve policies. And as a result, we've seen trillion-dollar scale in solar and wind, as well as in EV manufacturing. None of that would have occurred without the level of investment in Clean Tech 1.0 early on, right? And so we've reached trillion-dollar scale in those three markets. Now the question is, what are the next markets that we're going to hit trillion-dollar scale? There are certainly markets that were too early the last time around, but many of them are still here. I mean, hydrogen is one of them, for instance. Hydrogen, I was at conferences and presentations for hydrogen in 2003, 2005. But today the technology is in a place where you can see trillion-dollar scale in hydrogen, where it just wasn't ready in 2009.
Great. Okay, so it's a case of actually some of these technologies now being ready to receive that money and do something with it. Jonathan, when you look at this space, what are the technologies and sectors and industries receiving the most interest from early stage and later stage VCs and PEs?
Yeah, thank you, Claire. It's very nice to be here. You know, we at TPG Rise Climate, we're evaluating very broad spectrum and within the climate ecosystem, and that ranges. In our case, we're looking at situations that have graduated beyond venture capital and are into that growth and scaling phase. So that is picking up everything from long duration storage, biofuels, sustainable aviation fuels, software that's powering grid management and so on, material space, carbon capture. It's very broad. We're really thinking of climate as a sector the same way you would healthcare or technology, and that opens up a really big universe of opportunities.
And thank you, that's helpful. So Carmichael, coming to you and your work with particularly material impact and breakthrough energy ventures, part of the BEV's mandate, right, is to invest in technologies that aren't traditionally attractive to quick returns and exits. What are the technologies you've been looking at, or you think actually still haven't received as much VCPE funding or as much interest as they should have done, that you'd like to highlight?
Oh, can you?
Yeah, we can hear you.
That's interesting. I think we've lost it. Jigar, can you hear me?
Yeah, she just asked you about what the next generation of VC you know, technologies might be they're missing out.
Okay, maybe we can come back to Carmichael when he's got audio sorted. Do you want to answer that for us, maybe, Jigar, while we were just waiting to see what happens with Carmichael?
Sure. I mean, I think when you think about trillion-dollar scale, the next set of technologies where government policy has created a clear pathway is, for instance, sustainable aviation fuel. I think you're going to see a huge amount of money into, I think you saw the announcement from 12 the other day, you saw announcements from some of the world's leading producers scaling up for the low carbon fuel standard credit program in California. I also see a huge amount of money going into small modular reactors, micro reactors, and even fusion. I mean, I think we saw a few big announcements there. So I think when you think about the next set of trillion-dollar markets, we're starting to see a huge amount of not just innovation, but innovation turning into commercialization in these sectors. I'd also talk about plastics and recycled plastics, the circular economy, and then also just minerals, right? Critical minerals, batteries. It used to be that we were all just saying that lithium-ion batteries were going to be it, but today I think you see 5 or 6 additional battery chemistries with additional critical mineral supply chains that are coming strong and are able to meet the same level of cost performance as well as value performance of lithium-ion batteries.
Great, that's helpful. Can you hear us now, Carmichael? It doesn't look like it. So, Jonathan, you mentioned you're in the growth equity space, and I think what probably a lot of climate tech startups have struggled to do is actually go from the Series A and B they've been raising across that valley of death to the large amounts of money that will help them commercialize the technology. Jigar was mentioning things like batteries, nuclear fusion, hydrogen. These are capital-intense projects that require a lot more funding than a software startup does, for instance. Can you talk to us a bit about the role of growth equity in this space particularly? Because it's a bit of a new area for big PE firms like TPG and others to be getting into. What do you think specifically the role you can play in growth equity for climate is?
Yeah, Claire, it's a great question, and it very much is the driving force behind the pool of capital that we are just wrapping up raising at TPG. So we came to the market earlier this year on this premise that these are very capital intensive physical type companies, very different from the technology revolution that we've all lived through over the last several decades. And accordingly, we have raised a private equity style fund, which we've now closed on a little over $6 billion, and we're on our way to raising a little over $7 billion when all is said and done here, precisely so that we can be a growth source of capital for companies that, as we're out in the market every day talking to, their business plans have $300, $400, $500 million capital needs in many instances. And whereas earlier in the year, we saw a lot of companies jumping to the SPAC market because that was uniquely a big enough pool of capital to fund those business plans, we're glad to be offering effectively a private alternative for companies that might otherwise not be ready for the public markets and all the demands therewith. So we're having an interesting dialogues in the market every day with companies that need a lot of capital, and we're happy to be bringing that private equity toolkit to help them grow and scale. Which, by the way, per your initial question, I think that's another difference between cleantech 1.0. Is having these pools of capital, whether they're coming from the government through things like what Jigar's doing or things that we can provide, is to help them get through that next big phase in their evolution with the capital behind them to support the growth.
Yeah. Carmichael, can you hear us now?
I can. I went off the headset and I'm going computer.
Great. So you didn't miss much, but we've been talking a bit about some of the stuff that actually this is great. So where Bev can come in and where Bev is really, I think, important here is highlighting the areas that are really hard to scale, where capital is important, and maybe where traditional VCs wouldn't have gone, right? We're not looking at software or kind of maybe endless scooter sharing platforms. We're looking at things that actually, you need, like Jigar was saying, I don't know if you heard him, but things like nuclear fusion, right? Modular reactors, hydrogen, battery storage. He mentioned plastics. Are there other areas you're looking at that you think, for the VCs in the audience, they should be looking to, or other kinds of investors should be looking into?
No, I think I did hear what Jigar said, and I agreed with everything that you said. Maybe I'll just come back, instead of naming just specific technologies, I would just look at whole areas that I think are still undermined. So look at stuff in oceans right now. I think there's think about right now, there's probably more going on in outer space than we're really doing in oceans. Does that really make sense when you think about the richness of what we can do in oceans? And within subsets like that, I think there are lots of opportunities. But I actually agree with a lot of the topics that Jigar brought up. We're seeing those that just 5 years ago people wouldn't touch them with a 10-foot pole, but today they're being addressed. And of course, carbon capture is still, as far as I'm concerned, pretty much nowhere in terms by comparison to other areas.
Yeah, definitely. So actually, Jigar, going back to the point that Jonathan was making, in that actually now we're beginning to see VCPEs enter areas that a decade ago were maybe seen as being too risky or not enough returns. And that's where kind of the LPO, right, the Loan Programs Office, stepped in and said, we're going to actually prove that we can not only make money in this space, but we can actually really scale stuff that maybe the private sector doesn't want to touch. Can you tell us a bit about the role of the LPO now and how that might change or not change if we are going to see this big influx of private capital also scaling kind of the hard to scale climate tech?
No, it's a good question. I think that in general, the SPAC market as well as the private market is very important. But that pitch that investors make is really a pitch around the future of how things are going to get better. And it's an equity story, right? And most of these entrepreneurs have not really been able to put together a debt story. And I think, as we know, $1 trillion scale requires debt, right? Because that's how infrastructure is funded. And so when you think about LPO's mission, when the secretary came in, we had almost no applications. Today we have 100 applications that are either in the office or being actively submitted. And it's for about $80 billion of capital. So you can imagine it's being matched with equity. And it's across 17 sectors, right? So it's a pretty big diversity from EV manufacturing to batteries to critical minerals to nuclear. We got our first nuclear application in, and we have, then you've got about 12 carbon sequestration and storage projects and other things that are coming in. I think that in general, the world needs a better framework around how this whole evolution and migration from the past to the future is occurring, right? When you think about the oil industry and the coal industry and others, they were very traditional corporate equity and debt. The solar and wind industry really transformed project finance for good in the climate space. And the vast majority of entrepreneurs in this sector have no idea what I just said. And they have no idea how to use debt. They don't know how to use project finance. And so when you think about how all of these pieces are going to come together, we need to create a demand signal. And you saw the president make huge announcements in that area around making sure that we're buying green cement and that we're buying green steel and that we're buying electric vehicles and all those things. But then we also have to figure out how to build a bridge to bankability for these entrepreneurs, because the debt markets are not going to meet them halfway or 3/4 of the way. You either qualify for senior commercial debt or you don't know how to raise it. And so the LPO has stepped in and is providing guidance to all these entrepreneurs around, here is what a debt data room looks like, which is different than an equity data room. Here is how we actually figure out how to put these pieces together. And as a result, once we provide a loan to these entrepreneurs, they are sought after by the commercial debt markets because now they're ready to be served. And it's not a technology thing, it's really a conversation and really an emotional thing where they have to move their brains away from equity and towards debt to attract that capital.
Great. Yeah, that was really helpful, because you're right, it's a complex topic, so it was nice to hear it explained so well. And Jonathan, going back to what you were saying earlier about growth equity might be another alternative route to avoid maybe going public too soon for some companies. So how do you look at yourself making an exit, or how do you look at returns for yourself? Obviously, if you're funding companies with huge valuations, or by funding them to Series D and E, they are receiving huge valuations, potentially the M&A market is no longer as attractive as it might have been to early stage startups. And we've seen M&A as being the main exit, actually, for a lot of climate tech startups. So are you looking at then giving them that growth equity to help prepare them for public markets? Is that really the only route, do you think, to some of these larger climate tech exits?
I don't think so. I think, as with traditional private equity, the public markets will be a route, but not the only one. We're really seeing it's the early days of this sector, and one of the things, Claire, that we're really focused on is we have a dual mandate to make financial returns and impact, and we measure that as it relates to our climate investments, what we call a carbon yield. So we look at carbon abatement per dollar invested, and part of what we're betting on is that as we help to scale these climate companies and the impact that they'll have, that will have increased interest in be they strategic buyers or the public markets. You know, the public markets today, there was recent research by Bank of America that the cost of equity is about 10% lower for ESG focused companies that are in the top quartile in ESG performance. So the market is paying a premium for forward-thinking companies on ESG and on climate in particular. So we look at it and say, a lot of these companies, just like companies jumped early to the public markets earlier in my career, in the late 90s when it was seen as a good thing to jump too soon. And we're seeing some of that repeat itself here. And so I personally expect there'll be a slowdown in that jump to the public markets, and companies will seek to stay private for longer, just like you've seen companies like Uber lasting in the private markets for longer periods of time because the capital became available to support them through that phase and ultimately become terrific public companies. We very much can see that trend repeating itself. So there will be strategic buyers. I'm quite sure, we have in our fund almost 30 companies that have invested alongside of us as LPs in what's a reasonably unnatural act to come off balance sheet, to be investors alongside us. And the reason they're doing that is to have visibility into these types of companies so that they can watch them grow and potentially want to add them to their portfolios over time. So that should be a route as well.
Okay, that's helpful actually, and that leads into the question I was going to ask Carmichael next, which is about different kinds of investors entering this space, right? Jonathan, obviously TPG, your Rise fund is quite specialized, but some of your LPs may not know much about this space. And Breakthrough Energy Ventures as well as prided itself in hiring a lot of very smart PhDs and scientists, but that's very much not the norm for VCs. Your route has been a little bit different. Do you think you're seeing, and you're meeting at events, and you're co-investing now with investors who actually don't know much about this space or are learning quick, obviously on the job, and how is that changing the color of the kinds of investments you're seeing and what's going on there?
Yeah, I love that question. I want to take something that I heard Jigar say, and I just heard Jonathan say something that relates to it, and it all comes back to what's different now. One word that I'll tell you that's hugely different right now is just the amount of collaboration that you'll see right now around climate. I mean, it's fundamentally, you take a topic, this will come out in an announcement soon. You take a topic like nuclear, where you may have only had a certain select kind of folks who would put money into it. You're going to start to see financings that you're going to be shocked at the diversity of investors in some of these nuclear companies on a topic like nuclear that a lot of people can't, don't really understand it completely. And some understand it quite well, and just the whole collaboration across the board, and the different types of investors at different stages, different levels of expertise, like you said at BEV. You can see my periodic table that's behind me. We're loaded up with scientific expertise. I'm the business decision maker. Keep that in mind, right? And so, there's that. And maybe come back to something that Jonathan said as well, which is this option between public and private. And I couldn't agree with you more, Jonathan, that you said you're going to see in the future more and more companies opting to stay private. I can tell you that this year, in the first half of this year, we had over, I'm going to call it 15 of our companies get approached to go public via SPAC. We had maybe 2 or 3 get approached to go public the old-fashioned way, okay? What was really pretty impressive is we had maybe 10 to 20% of them actually say they wanted to do it. And I want you to think about that for a second. This is a sector that historically has been starved for large amounts of capital. And so as you start to think about the capital you need to build your business and the option of going public, not because you want to be a public company, but because you can load your balance sheet up with the capital. And to Jigar's point, like most entrepreneurs don't know a lot about how to do project financing and debt. I couldn't agree more. So they're looking at, equity as a method. And then keep in mind, definitely less than 20% of those companies, but I think even less than 10% said they didn't want to do it. And in response, the private market responded to the overtures from the SPAC overtures and responded with a diversity of investors that would really make you kind of shake your head in a really positive fashion and say, now that's collaboration. So, and so we've had, 10 of those companies do spectacular private financing. To Jonathan's point, opt for the private route and to stay private because they really just wanted the capital to build their businesses. And I think as those examples emerge and become more public, some of them have been announced already, but as they become more public, and by the way, BEV is not the only firm that's been doing that in our portfolio, all of our co-investors. So, it's a pretty unusual time right now for financing.
Yeah. Do you think, maybe Jigar, I can ask you this question. Do you think that the rush of money and large amounts of money and larger rounds being raised and the ease with which some companies are doing it reflects a lack of actually potentially attractive targets? I know there's thousands of startups out there and there's lots of interesting ones, but there's also, I think, a lot of innovation gaps still. Do you think we're actually seeing the full potential of startup innovation, or is this kind of hunger for investing in anything that's moving really an actually reflection of the fact we need more entrepreneurs and more innovation?
Yeah, I would say that the Paris Agreement was really about countries coming together around innovation, right? I mean, you had mission innovation, you had breakthrough innovation, right? And then I think what happened in the last few years is that the IEA, the International Energy Agency, mapped out 436 technology pathways that were basically proven scientifically, but now needed to break out. And and you saw the collaboration between the Loan Programs Office and Breakthrough Energy. So I think we're now embarking on breakthrough development and breakthrough deployment, right? And as much as this sector is covered by the media, I would say there are large pockets of innovation that are really ready for prime time that have not been covered by the media. I'll give you an example. There are two companies that we're working with that have advanced, plastics conversion from recycling to new usable plastics without the degradation. And I think the media has covered them with plastic straws, right? But they're actually being sought after by the world's largest companies because they get the fact that this is going to be a huge area. So I would say that as much as people think that this area has been picked over, we've only just gotten started.
Great. Well, we're almost out of time, but I want to finish up with a question to each of you on, this is your moment now to pitch or at least share with us one or two really exciting companies that are in your portfolios, I guess in Carmichael and Jonathan's case, or other companies you've come across, Jigar, in all of your work with the LPO that you're really excited about and you want to just share briefly. Jonathan, do you want to go first? Sorry, I didn't prep you for this, so you may have nothing to say, but if you have something on top of your head.
We better be able to answer this. I would say, most interestingly, we just announced a little over 2 weeks ago now, along with our friends at ADQ, $1 billion investment into Tata Motors in India, spinning out effectively their EV business. And we're excited about this for many, many reasons, the underpenetration of EVs in India and the opportunity broadly. But what we think is really interesting about this is you have an existing traditional ICE car business where they're saying, we want to deliberately separate out the EV business, which is a unique thing because today, obviously, you have the opportunity to invest in companies like Tesla that are doing EVs in and of themselves, and you have the General Motors and Fords that are pursuing both strategies. This is an opportunity to really partner with an incumbent to develop their EV business, and we're very excited about where that can take us and the fact that we're able to spotlight what they're doing, a lot of really great things on the EV side.
Great, thank you. Carmichael, what about yourself?
This is one we can get ourselves in a lot of trouble, right, guys? I mean, yeah.
Which one of your children do you love the most?
No, but I'm going to answer. I'm going to answer it. I'm going to caveat it. I'm going to answer it by prioritizing two companies that I think you'll see some really interesting news in the next 30 days. All right, 30 to 40 days. So one I mentioned nuclear. So I would look at Commonwealth Fusion System, CFS. It's really just a spectacular fusion company, out of MIT. They had a great result this summer that they actually publicized in real time. And I think you're going to hear some really interesting, exciting news about them in so-called the next 60 days. And the other one that I'd pick is Source. So this is sort of a combination. This is capturing water ambiently from using something called a hydro panel, sunlight and air. And that company is a really interesting one because it both has a strong climate story in terms of what it does to eliminate things in manufacturing, but I think it just has a very good, overall do good for the world story, where providing clean drinking water to the masses, democratizing it.
Great, thank you. And Jigar, briefly, so which of your children do you love the most then?
I don't think I'm allowed to mention any children, but what I would say is that I think that there is a lot more specificity behind the Secretary of Energy's Earthshot initiatives. So we have a very clear pathway to reaching $1 a kilogram in hydrogen. We have a very clear pathway of reaching $100 a ton in CO2 capture, as well as with long duration energy storage. And so the one thing I would alert investors to is that DOE is not making this up. We have a very clear understanding of how these cost reductions are going to occur. And I think we all agree that if those cost reductions do occur by 2030, then all of these technologies become fully mainstream.
Great. That's a great forward-looking point to end on. So thank you so much, gentlemen, for joining us. I'm sure everyone will join me in giving them a warm round of applause for their time.